What happened to silver while you were sleeping? The precious metal that soared to astronomical heights just weeks ago has come crashing down in one of the most dramatic sell-offs we've seen in years. And as we head into Wednesday, all eyes are on the Federal Reserve minutes that could determine whether this crash continues or if it's time for a comeback. I'm going to break down exactly what's happening in the silver market right now, why it matters to you, and what Wednesday's Fed announcement could mean for your investments. What happened to silver while you were sleeping? The precious metal that soared to astronomical heights just weeks ago has come crashing down in one of the most dramatic sell-offs we've seen in years. And as we head into Wednesday, all eyes are on the Federal Reserve minutes that could determine whether this crash continues or if it's time for a comeback. I'm going to break down exactly what's happening in the silver market right now, why it matters to you, and what Wednesday's Fed announcement could mean for your investments. Let's talk about what just happened. Silver prices plunged over 10% in a single session on February 12, 2026, dropping from $84.88 to as low as $74.58 per ounce, 58 per ounce. That's not a typo. We're talking about a double-digit percentage drop in just hours. Forbes. This wasn't just silver. Gold tumbled alongside it, falling from above $5,100 to around $4,900. The entire precious metals market experienced what analysts are calling a risk-out move, meaning investors rushed to liquidate positions as technology stocks also dipped. According to Victoria Krusek, senior research analyst at Suckton Financial, this sell-off was flow-driven rather than fundamental. Translation: falling from above $5,100 to around $4,900. The entire precious metals market experienced what analysts are calling a risk-out move, meaning investors rushed to liquidate positions as technology stocks also dipped. According to Victoria Krusek, senior research analyst at Suckton Financial, this sell-off was flow-driven rather than fundamental. Translation: this was about investor panic and liquidity hunting, not necessarily a change in the underlying value of silver itself. As of February 16, 2026, silver is trading around $77 per ounce, down over 18% from its peak just a month ago. Trading economics. But here's the million-dollar question. Is this crash over, or are we just getting started? To understand where we're headed, we need to look at where we've been. Silver had one of the most explosive rallies in recent history. Starting from around $30 per ounce in early 2025, silver skyrocketed to over $120 per ounce in late January 2026. That's a 300% increase in less than a year. What drove this insane rally? According to JP Morgan's head of precious and base metals research, Gregory Shearer, it was a perfect storm. JP Morgan first, silver markets have been in fundamental deficit since 2021, meaning demand has exceeded supply by 100 to 250 million ounces annually. That's massive when you consider total mine supply is only around 850 million ounces per year. Second, fears of Trump administration tariffs on silver imports caused massive movements of metal from London to New York, creating extreme physical market tightness. Third, Asian retail investors, particularly from India and China, piled into silver in unprecedented numbers, driving prices from $80 to that peak of $120. But what goes up dramatically can come down just as fast. The catalyst for the crash? The nomination of Kevin Warsh as Federal Reserve Chair. Warsh is seen as more hawkish on interest rates compared to other candidates, meaning he's less likely to cut rates aggressively. This strengthened the dollar and put immediate downward pressure on precious metals. Now, let's talk about Wednesday. The Federal Reserve is releasing the minutes from its last policy meeting, and this could be the most important economic event of the week. Here's what's at stake. These minutes will reveal the internal debates within the Fed about future interest rate policy. Currently, U.S. money markets are pricing in a 25 basis point rate cut in July 2026, with about 60 basis points of total cuts expected this year. Morningstar. Why does this matter for silver? When interest rates are low, precious metals like silver and gold become more attractive because they don't offer yields like bonds or savings accounts do. Higher rates equals pressure on silver. Lower rates equals rocket fuel for silver prices. According to HSBC analysts, the January minutes will likely detail the arguments that support a wait-and-see approach versus those that could support rate cuts. This is critical. If the minutes show the Fed is leaning toward cuts sooner rather than later, we could see silver rebound quickly. But there is another complication. Recent U.S. jobs data showed the economy created 130,000 jobs last month, strong enough to make immediate rate cuts unlikely. However, inflation data came in below forecasts, reminding markets that rate reductions are still probable later this year. Also dropping on Wednesday, U.S. GDP data and PCE inflation figures, the Fed's preferred inflation measure. If GDP shows continued economic strength, it could further dampen near-term rate cut expectations and keep pressure on silver. So what's the bottom line? JP Morgan expects silver to end 2026 around $85 per ounce, higher than current levels but well below those January peaks. They're cautious in the near term, believing the market still has froth to shake out. The bank's Gregory Shearer warns that silver remains vulnerable to volatile swings. You could have a down day in gold of 1 or 2%, and that translates into almost 10 to 15% of a drop in silver. Other experts are more bullish. Gold Silver's lead analyst Alan Hibbard expects silver to trade above $100 in 2026, while some analysts believe $200 per ounce is possible, though that would require unique economic conditions to align perfectly. Here's the reality check. Silver is a smaller market than gold, about 1/10 the size, which makes it inherently more volatile. And unlike gold, silver doesn't have central bank buyers providing steady support. The demand is split, about 60% industrial applications, especially solar panels, electric vehicles, and AI data centers, and 40% investment and jewelry. There's a major risk on the industrial side. At current prices, silver now represents over 30% of solar panel costs, up from just 1.5% historically. Major Chinese manufacturers are already announcing plans to substitute copper or develop silverless solar panels. This could significantly reduce future demand. The silver market is at a crossroads. Wednesday's Fed minutes will provide crucial insights into whether we're headed for further declines or a recovery rally. Keep watching those interest rate signals, monitor industrial demand trends, and remember that silver's smaller market size means bigger swings in both directions. Will silver crash further, or is this your buying opportunity? That depends on what the Fed reveals on Wednesday and how much risk you're willing to take on one of the world's most volatile commodities. The information provided in this video is for educational and informational purposes only and should not be construed as financial, investment, or trading advice. I am not a licensed financial advisor, broker, or investment professional. The content presented represents analysis of publicly available information and market data as of February 2026. Silver and precious metals investing involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Commodity prices are highly volatile and can experience significant fluctuations based on economic conditions, geopolitical events, Federal Reserve policy, and market sentiment. Before making any investment decisions regarding silver, precious metals, or any other financial instruments, you should conduct your own due diligence and consult with a qualified financial advisor who understands your specific financial situation, risk tolerance, and investment objectives. The views and opinions expressed in this video are solely those of the presenter based on current market analysis and are subject to change without notice. No representation or warranty is made concerning the accuracy, completeness, or reliability of any statements, data, or analysis presented. By viewing this content, you acknowledge that any investment decisions you make are your sole responsibility and you accept all risks associated with such decisions. Neither the creator of this video nor any affiliated parties shall be held liable for any financial losses or damages that may result from actions taken based on information provided in this video.